Okay, so today we're tackling a pretty wild financial claim. Get this, the idea that you can make a single, one-time investment and have that turn into a pension for the rest of your life. Yeah, I know, it sounds almost too good to be true, right? So let's really dig in and see if this strategy actually holds up. All right, so here's the big promise, the central question we're looking at. Can you really take just 50,000 rupees, a one-time thing, and turn that into a 25,000 rupee pension every single month for life? I mean, it sounds like something out of a financial fairy tale, doesn't it? But there's a specific strategy that says it's possible. So let's break down exactly how this is supposed to work. Okay, first things first, we're going to get into the core philosophy here. Because, before we even touch on the numbers or the specific funds, we really need to get our heads around the fundamental idea that makes this whole plan tick. So, what's really fascinating about this whole approach is just how simple it is. I mean, we're not talking about constantly buying and selling stocks or being glued to your screen every single day. Nope. The idea is to make one single investment and then just let it go. You let time do all the heavy lifting for you. The real key, the secret ingredient here, is patience. Just letting your money work for you over, well, decades. All right, so what's the engine that's supposed to drive this whole thing? Well, it all boils down to one very, very specific type of mutual fund. So the engine we're talking about is what's called a sectoral fund, and it's from SBI Mutual Fund. The source material points out a couple of things that might build trust. First, it's SBI, right? A huge, well-known government-backed name. But second, and this is the really crucial part, it's a sectoral fund. That means it doesn't spread your money all over the market like a typical fund. Instead, it makes a super concentrated bet on one single industry. And in this case, that industry is healthcare. We're talking big names like Sun Pharma and Dr. Reddy's. And this quote really just nails the whole investment idea, doesn't it? The core belief here is that healthcare isn't a choice. It's a non-negotiable expense. I mean, think about it. When times get tough, you might cut back on eating out, maybe cancel a vacation, but you're not going to skip going to the doctor. Just look at the pandemic. So many industries slowed way down, but healthcare, it was running full throttle. And that is the bedrock of this entire long-term growth argument. Okay, now we get to the real powerhouse, the fuel that makes this whole plan go, the absolute magic of compounding. This is where a tiny little seed of an investment starts its incredible journey to becoming something, well, something huge. Let's actually see this in action. The source gives an example using just 10,000 rupees. Now, we have to assume a pretty optimistic 18% average return each year. But with that, after 5 years, your 10 grand more than doubles. Not bad. But the real magic, the real wow moment, happens later. Fast forward 20 years, and it's over 2.7 lakhs. And after 30 years, it just explodes to over 14 lakhs. You see how the growth curve just goes almost vertical in those later years? That's compounding. Okay, so let's take that same principle and apply it to our main number, that initial 50,000 rupees. Sticking with that same 18% average return projection, in 15 years, it grows to almost 6 lakhs. But look, the real trick is holding on for the full 30 years. That's when it could potentially become this massive pile of money, over 71 lakhs. This just hammers home the point, right? This is not a get-rich-quick thing. It's a 30-year game of pure patience. So let's say you did it. You waited 30 years. You now have this big chunk of cash sitting there. So what's next? How do you actually turn that into the monthly pension we've been talking about? Well, this is where a nifty little tool called an SWP comes into play. So, an SWP, that stands for Systematic Withdrawal Plan, is basically the exact opposite of how you probably save money now. Instead of putting a fixed amount in every month, you set it up to take a fixed amount out. It creates this steady, predictable stream of income, like a paycheck, coming directly from your investment. Yeah, probably the easiest way to wrap your head around this is to think of an SIP, or Systematic Investment Plan. A lot of us are familiar with those, right? An SIP is what you use when you're building your wealth, the accumulation phase. Well, an SWP is for the payout phase. It's for when you start living off that wealth. It's like you're just flipping a switch from save mode to spend mode. Now, hold on, because this next part is probably the most mind-bending claim of the whole strategy. The idea is that your money doesn't just last, it actually keeps growing even while you're taking money out every month. The math behind it is simple in theory. The amount you're taking out, say 3 lakhs a year, is less than what your remaining money is earning in growth. So, for example, the source suggests that even after you've pulled out 15 lakhs over 5 years, your original pot of money could have grown to over a crore. But, and this is a huge but, this whole beautiful idea hinges entirely on your investment still getting a consistent and, let's be honest, very high 12% average return while you're in retirement. Okay, we've seen the plan, we've seen the projected growth, and we've seen how the payout is supposed to work. Now it's time for arguably the most critical part, the fine print. The specific fund, the costs, and the risks that you absolutely, positively need to be aware of. So let's name it. The specific fund that is at the very heart of this entire strategy is the SBI Healthcare Opportunities Fund. This is the one. This is the vehicle the source material uses for all its calculations and projections. All right, now let's talk about the fine print. And seriously, if you only pay attention to one part, make it this one. So you've got costs, right? There's an expense ratio, which is basically an annual fee of just under 1%. You've got taxes you'll have to pay on any profits. But the most important, the absolutely crucial thing to understand is right there at the bottom. The entire plan we've walked through is built on projections using past performance, and that is never a guarantee of what will happen in the future. An 18% average return for 30 years straight, that is incredibly rare. Markets go up, but they also go down. Relying on these rosy projections for your retirement is without a doubt a significant risk. So where does that leave us? On one hand, this strategy is built on two really powerful ideas, that unstoppable demand for healthcare and the incredible magic of compounding over a long, long time. But it makes a massive trade-off. It throws diversification, the whole don't put all your eggs in one basket rule, right out the window by betting everything on just one single sector. So the final question, the one you have to ask yourself, isn't just, could this work? It's, am I willing to take on that kind of concentrated, single sector risk for that potential reward?